Let's get into it. This is the monthly market call for October 2025. A lot to cover here. I'm going to get through. Actually, the one thing I'll say for everybody is if you, a lot of people have asked, like, what, because I do these regularly, is there something that we can do for you? The one thing I would ask is if you can leave me a five-star review on Google for Valerie Real Estate. Just Google Valerie Real Estate and leave us a five-star review. For those of you who are in the real estate business, you know how important this stuff is. So that would be a huge help. And I'll return the favor if you put your name in as a review and just let me know. I'll leave you a five-star review as well. But I know it's one of those things that helps a lot in the business. Anyway, let's get into it. So there's a couple of things I'm going to cover today. I'm going to cover interest rates. Obviously, we have a decision tomorrow. I think, market's kind of pricing a 25 basis point cut. Unemployment, inflation, two factors that I think the Bank of Canada is paying a lot of attention to when it comes to the interest rate decision. I'm going to talk about mortgage delinquencies. Going to talk about a little bit about population growth and the housing supply outlook, and then sort of some charts from Oxford Economics as well. So to start off with on the interest rate side of things, the Canada 5-year bond yield. This is a look back until or since 2017. So we're not even really back to pre-COVID levels of sort of like your capital cost environment. Um, and when I like a lot of the times when we talk about recovery, there's two sort of scenarios that you can think of. One is we go back to the craze of the pandemic, which is super unlikely if you look at sort of like where your interest rate environment was during that period of time. And then two is you go back to sort of a pre-pandemic, like normal market. But even then, we're still not back to a bond market where that seems possible. And the bond market doesn't really seem to be buying into the idea that the Bank of Canada is going to cut much more than they have already. Um, that could change, obviously. If you look at this, though, like on a 1 year, the Canada 5-year bond yield is basically the lowest that it's been in the last year, other than like a brief period of time, sort of like beginning of this year when the Canadian election was happening, sort of like March and April. And so this brings me to sort of like the forecast of like what the market is feeling about what's going to happen to interest rates. And sort of this is like the best kind of forecast. It seems like everybody sort of feels this way. I think I have the big six on this as well. I'll hop back so you can see the original chart, but you've basically got so the forecast starts where this line is. So that's where we are present day. So your variable mortgage rate is expected to continue to drop. It looks like about another 50 basis points, maybe 75 basis points. It looks like your fixed rate actually isn't really expected to drop. I don't think that this is actually like I do think that people say they can't see the presentation on my video. Let me screen share. It's on my video, but I'll screen share as well. Give me 1 second here. Can you guys see that as a screen share now?
Yeah, that looks better.
And give me 1 second. I'm just going to make a couple of changes to my recording setup then.
I've got a question already, actually.
Yeah, go ahead.
Somebody says, is it true that when bond rates are high, does the opposite happen with interest rates?
Uh, no, typically bond rates track the interest rate or sorry, bond yields typically forecast what the interest rate environment is intending to do. So the bond market will communicate through their yield expectation, and their yield expectation is basically the price that they're willing to pay for a bond, that what they expect to happen to interest rates in Canada. And so and banks typically will price their mortgages off of the Canada 5-year bond yield, because basically if you're a bank, you can either lend money to the government of Canada at whatever our bond yield was there, 2.6%. And that's the interest rate that you would get from the government. That's what a bond yield is. So if you went and bought government bonds, they would pay you 2.6% interest on that bond on an annual basis. And the term is a 5-year term, 5-year bond. There's 2, 3, 5-year bonds. And then you could also, lend money to myself or Courtney, and you might deem us to be a little bit riskier than a bank, or sorry, than a government. I don't know. Some people might argue that the Canadian government might be more risky than us, but the way that the bond market or banks perceive this is that the government is far more likely to pay their loan than myself or Courtney, and so they'll put a premium on top of the government of Canada bond yield, and that's the spread. So typically, you'll hear for mortgage rates, prime plus, or sorry, GOC plus 1 to 2%. That's where your fixed rates come from. So right now we're at GOC. Your GOC plus 1% is about 3.65%, which is kind of where your low end of your fixed curve is right now. So you unmuted there for a sec.
Oh, yes, two more items. Somebody asks, is there a close correlation to the 10-year US bond rate as well?
I wouldn't say a close correlation, but like all bonds sort of forecast the same thing, which is the market's outlook. You'll often see a divergence between the 2 and 10. And this is really getting like more into what sort of like I would be relatively unqualified to discuss, but your bond traders will look at something called a 2S 10S spread, or a 2S 10S butterfly, which basically shows like the gap between what the market thinks the long end of the interest rate environment is going to look like, and versus the short end of the interest rate environment is going to look like. And when those things flip too much, then it indicates that the market is expecting some sort of change, either to the upside or the downside. Usually these inversions end up being, you'll often hear the word yield curve inversion. Usually when you see a yield curve inversion, it's considered a recession signal, although we've seen like 4 of them in the last 3-4 years, and none of them we have managed to avoid a technical recession. Any other questions on deck there while I'm on the slide?
Yep, someone was just asking to see the previous slide. They couldn't see it.
Oh yeah, for sure. It's just a bond yield chart. Yeah, that's it. Bond yields back to 2017, and then bond yields in the last 365 days. All of this to say that basically the outlook from most of the big banks, most of the big economic houses, is that we will see mortgage rates on the variable side probably come down a little bit, flatline, and then come up into 2027. And the fixed rate side, you might see a little bit of downside, and then flat, and then probably up sooner rather than later towards the end of next year. And the big reason for this is government spending, right? So we know we have our budget coming up. Pay close attention to what the bond market does on the budget announcement day in Canada. Basically, we're going to be running a bigger deficit than we've ever run before. And when you hear about deficit spending, what that means is you have a lot of bonds, right? The government is going to be asking the market for a lot of money to finance that budget. And when they do that, they send out a lot of bonds, which means that there is an oversupply, which means that the price would go down, which means that your yield would probably go up, because your yield is like your cap rate. For those of you like speaking real estate term, it's like your cap rate on a bond. The next piece here is actually, this is basically just the same chart, but this is your bank. What the banks are actually forecasting, what your big six is. And I mentioned in the last call, like my perspective is that it is worth paying attention to the way that the banks are interpreting the market right now, because they're the ones who lend the money to our clients who are buying and selling real estate. And so they really do decide on the fate of the market. And right now, like, I would say we're in what I would call a credit contraction. You're seeing not a lot of willingness to lend. Banks are really looking for the best clients, the best borrowers, and so like by and large, buyers can be as bullish as they want. And I think we are seeing a return of optimism into the market. But if banks aren't as optimistic as the buyers and they're still feeling risk and trying to mitigate that through their lending policies, then the market's not really going to recover until buyers can, until we start getting to a looser credit environment. What I think could catalyze that quite a bit is probably early next year if OSFI does make changes to the stress test, which is something that they've been discussing doing. That would probably loosen the lending environment a little bit to the lower end of the market. So your first time buyers, it probably would make it worse for your investors on the top end of the market. The interesting part here about the rate environment, this comes from Richard Diaz on X. If you don't follow him, I would encourage you to. They have a YouTube channel as well. He's one of the hosts of the Looney Hour podcast with Steve Saretsky and Keith Dicker, and we just did an event with them in Vancouver actually. But we just kind of crossed. So there's this idea that interest rates are negative on a real basis. So when adjusted for inflation, we just crossed the line to the point where we now have negative real rates again. So if you look at like historically, basically the last, I don't know, several decades until the 0809 global financial crisis, we always had what you would call positive real rates, which means that your rate of inflation is lower than your interest rate. And that means that your cost of borrowing is higher than how quickly your money is being devalued through, or the cost of goods is inflating. And the problem with a negative real interest rate is that if the cost of goods are going up so quickly, like as an example, a TV or a t-shirt or a car or whatever, for your groceries, and you can borrow money for less than that, which you can't obviously, but like the perceived environment is that the banks or like financial institutions can borrow money for less money than the rate of inflation, then it becomes like the financially intelligent thing to do, or like the right technical move to actually spend all of your money, right? Like if, for example, you could borrow money at 5% and the cost of some non-perishable food item or a piece of clothing or a stove was going up 8% per year, it would actually make sense for you to borrow as much money as you possibly could and buy a bunch of stoves and then sell them next year at an 8% premium, right? And you'd make that 3% spread. And so all of this to say, as you get into a more negative real rate environment, like we were only in positive real rate environment for like less than a year, about a year. As you get into a negative real rate environment, it starts to distort and create like a little bit of, not a moral hazard, but I guess like an irrationality on the lending side, and this could potentially lead to looser credit terms and actually growth in the debt side of things, which is what fuels growth in the real estate market. Same thing from Oxford Economics, basically their rate forecast. Again, this is just your two rates kind of smushed together based on your actual 5-year fixed rate. So they're basically not seeing much change in the rate environment. And it's not to say that they're right, to be honest, because I'm of the opinion that we'll probably see some recessionary economic factors over the next 6 months, and that'll change the rate outlook. But that we don't have those yet. So as it stands, you kind of can only go with the data that you have, and that's their forecast. If and so if you're advising clients, or if you're thinking about and this is probably just the right way to model a deal or an investment or purchase conservatively anyway, is would I still buy this property if in 5 years when I had to refinance, my interest rate wouldn't be lower than it was? It's a pretty level-headed way to approach a real estate transaction regardless. So I think that their forecast here is probably not unhelpful. Another one from Oxford, they showed the correlation between the unemployment rate and residential mortgages in arrears. And their forecast is that unemployment will rise to mid-sevens at a national level, and your mortgage arrears will rise to approaching 30 basis points, which is like nothing, right? It's like 0.3%. It's a different discussion whether or not our mortgage arrears number is credible, right? Like banks have a lot of leeway that they can give to people who are in arrears. as a borrower, you almost like have to be deliberately trying to show up as a delinquency number on the bank's uh, whatever you would call it, their statement, and this and in the CBA, Canadian Bankers Association numbers, you'd have to like basically if a big six bank, if you stop paying your mortgage, they'll send you like a letter. There's this whole thing called the Canadian Mortgage Charter. There's a bunch of things that they have to do that can kind of distort the reading of what a 90-day delinquency looks like from those banks. A little bit, we're seeing a little bit more delinquency on the B Alt-A, well, not even Alt-A, but B, B plus, C, obviously in your private mortgage side. And so we're seeing a lot of power of sale listings come online, and a lot of distress supply. This is a trend that I'd be paying a lot of attention to. I mean, I had 2 emails in my inbox today that showed me that basically that lenders are still actively taking properties back. Sorry, I just want to make sure that you guys can all still see my presentation. Okay, cool. Yeah, so lenders are one of the most active sellers in today's markets, right? So if you are a real estate professional, this is a trend I'd be paying a lot of attention to. I'd be calling all, and I've mentioned this many times on the monthly call. I'd be calling all of my mortgage brokers, all of my lawyers, all of my anyone who would see a file that is a delinquent loan, even past sellers who maybe were really high leverage and might need to right size their debt load, right? They want to sell the property, downsize into a smaller one, into a more affordable mortgage payment or whatever it is. I mean, these are the big themes right now because we're in this recession environment. We're seeing tons of job losses. We're seeing, the cost of living really impacting people. This is where I think a lot of the transactions are going to come from in the market right now. Loan to income of new mortgages is rising, which would tell me that we're kind of back to that point where people are actually increasing their debt loads. And a lot of this, I showed this in last month's presentation, but the um, debt to household disposable income in Canada was falling. We were deleveraging, and then it actually started ticking up again. And so this is kind of a point of concern from my perspective. The other very interesting part about this on the median loan to income basis is that the alternative to the stress test that OSFI is considering right now is a loan to income measure, where basically OSFI will actually underwrite the bank's portfolios based on the percentage of mortgages that they have where mortgages are over 4.5x or 450% loan to income. And now we're approaching a point where basically 30% of your first time buyers have loans over 450. Almost 25% of your repeat home buyers have loans over 450, and about 15% of your investors have loans over your 450. And the and so we're obviously not back to the highs of the pandemic, but there's a point of concern because as your market gets more and more indebted, the upside, the ability for more buyers to enter the market shrinks because you kind of get to your end, right? Like think about yourself as an individual, like you can take on you can go get another credit card or an auto loan or a mortgage or whatever, but eventually you hit a limit. And as a society, we the cumulative impact of all of those limits is us not being able to take on more debt, which means that we don't have much upside in our housing market unless something else changes. Interest rates come down, prices come down, wages rise. This is the same chart, just on an Ontario basis. This comes from a guy named PH4 on Twitter. This is your unemployment for working age population, so 25 to 54, and it shows sort of your mortgages in arrears. And this is interesting because you sort of broken correlation. Like our mortgages in arrears are actually a little bit more severe than historically, and you could see that coming out of the global financial crisis as well, where they sort of broke correlation. The other thing that arrears seems to track in kind of an interesting fashion is the change in house prices. So, and a lot of this is because, Canadian mortgages are very much an equity-based loan. So as long as your home is going up in value or you are increasing your equity position as a borrower, you can always borrow against some of that, right? So maybe after 4 years, you pay down a bunch of principal, or your home's gone up in value 2 or 3%, and you can always tap that with a HELOC or a second mortgage or whatever. decreases in home equity choke that kind of exit, and that means that Canadians actually are more likely to go delinquent because they have less equity to pull on to sort of reconfigure their personal debt situation. The other thing that mortgage arrears are worth looking at beside is your 5-year mortgage rate. So this is basically your mortgages in arrears and then your 5-year rate pulled forward. Or sorry, your mortgages in arrears pulled forward and your 5-year rate as it stands. And you can see that basically the other component to where there seems to be a bit of a correlation is interest rates. As interest rates go up, your delinquencies go up. As interest rates come down, your delinquencies often come down. And the reason is because it's cheaper for people to borrow. Prices tend to start increasing again. And so they might have more equity to pull on, like I just meant, like the slide I just mentioned. And so we are, we're getting close to the point where that 5-year, well, it's coming down, right? So we should see again in that there's that 23-month lag period there, but we should start to see arrears, peak and roll over within the next year or two. Um, the next piece I'll mention on mortgage side is like what's the Bank of Canada paying attention to going into tomorrow's meeting. And obviously we just saw our inflation print. Inflation's higher than most economists wanted it to be, and most economists forecasted for it to be. Big reason for this is something called the base effect on fuel costs. They did a really nice visual on the StatCan website, which basically shows how, in last month's reading, fuel costs were down 12.7%, but because there was this huge drop in September of last year, you're coming from a lower base. And so the drop, fuel costs are obviously rising, but the drop compared to last year is also significantly different. And so if you go back to the reading, you can see excluding gasoline, it ticked up ever so slightly, but CPI on its own actually ticked up pretty substantially. And I don't think that the central banks are super concerned about inflation right now, to be honest with you. I kind of get the vibe that they are comfortable letting the economy run hot, which goes back to that negative real rates slide that I mentioned, and I think a big reason for this is they're probably fearful that something's going to break at some point. We're already seeing a lot of data, and so they're trying to sort of like inflate the way out of a recession, which is, I don't know if it's really the best idea, but I don't run the central bank, so it doesn't really matter what I think. On the inflation side, groceries, these are just your household costs that are starting to kind of weigh on consumers. Groceries ticked up, the largest year-over-year increase in grocery prices since the bottom that we saw in April of 2024, so last year. CPI, so inflation actually rose, because I know, we're kind of looking at a national audience here. CPI actually rose in every province in Canada, which is pretty rare, to be honest. Like I can't even remember a time where it rose except for like when inflation was like 8% during COVID or whatever. So that's an interesting data point. So it's not like there's something happening that's sort of like dispersed or sorry, isolated to different areas. It does seem to be pretty indiscriminate in where inflation is impacting in Canada. This is an interesting one from my perspective, and I'm going to share a couple of charts on this because as real estate professionals, to me, this is a really easy and interesting way for you to interpret how inflation behaves right now. So it shows that rents are rising at a faster pace nationally despite mixed provincial pressures. Now, I think all of you are in the real estate space. You're probably pretty familiar with what's happening with rents right now. And if I were to ask you if rents are rising or falling, you would probably tell me that they're falling, right? But yet Statistics Canada's CPI is telling us that rents are rising. And there's a lot of reasons why this could be the case. But the one of the biggest ones is they measure both asking rent. So like if you're a tenant who goes and rents a new place, that's an asking rent, but they also measure rents that are just increased year over year based on the allowable amount. And that's sort of an inflation on rents, right? And in some markets where rents have grown a lot, like Calgary, and there's no rent control, or Ontario newer than 2018, and there's no rent control, those slight increases can actually materialize in bigger, broader increases across the whole, they call it a basket of goods on CPI. But and this is where population growth kind of comes in, and it becomes an interesting story. If you look at this chart here is from the Bank of Canada's last monetary policy report, and they're going to release another monetary policy report tomorrow with their decision. And this is the first chart that I look at because I always want to get an understanding for the composition of CPI. So this basically shows you, if you read it from top to bottom, each column is the composition of CPI and how it's changed on a month-over-month basis. And there's only one category that has been blood red for the last 2 years, and it's rent. Yet everything else, I mean, even mortgage interest costs are easing, right? It's showing mortgage interest costs that the increase in mortgage interest costs is easing. Rent, from my perspective, should also be easing. So I think that there's a problem with the way that CPI reads rent in the market right now. But both rent and mortgage interest costs, whenever the actual decline in rent that's happening in the market right now starts to materialize in rent CPI, that will likely pull down the inflation rate, right? And your inflation rate as it stands right now is like, I think over 30%, or I guess it says 27.1% of your inflation rate. So almost a third of your inflation rate right now is shelter costs. And a huge portion of that, 7.4%, is rent, and 5.8% of that is mortgage interest costs. We know that people are going to be renewing. Some people are renewing with higher mortgage rates. 60% of the mortgages are renewing over the next, whatever it is, 12 months or by the end of next year. Some are 60% are renewing or at higher rates. And that'll probably, if rates continue to drop, that'll actually, we're probably closer to 50-50 now. And by early next year, if we have, another 50 basis points off the overnight rate, maybe we get to less than half of people are renewing at higher mortgage rates, right? Because there was a bunch of people who took rates on a 3-year term, 2-year term in the last couple of years that maybe got a 5% rate and are actually renewing at a 4 or high threes. But then you still also have all of your 2021 mortgage rates where people got, 1% or 1.5. I guess those would have been variables, but 1.99, mid twos on a fixed. They're going to be renewing at higher rates. If we get to the point where more people are renewing with lower rates, then that mortgage interest cost component of CPI will continue to move down. Same thing will happen with rents as rents continue to fall. And you can see on this chart here that rent inflation and population growth, and this comes from IceCap again as well, population growth has basically fallen off of a cliff, and rent CPI, rent inflation, seems to be very, very closely track population growth, and it's fallen off a cliff too. And it is, from my perspective, is negative. Rent CPI should be reading negative at this point. It's not. When it is, that'll have downward pressure on CPI. So I'm not super fearful that inflation is going to be persistently high like a lot of people are. Tariffs are obviously the X factor here. I've discussed that many times. I did like 50% of my presentation last month was on the trade war and its impacts in Ontario. But we really don't know whether or not those trade war costs are going to get passed through to the consumer yet. And so we're still trying to figure that out. The other piece here is your mortgage interest costs and core inflation, and what your inflation looks like excluding mortgage interest costs. And so you can see, because the mortgage interest costs kind of got it was super low in the 21, it would have skewed CPI down, and it was super high in the 2023, it would have skewed CPI up. Now we're kind of getting back below that curve where mortgage interest costs will actually should actually start skewing the inflation rate or inflation reading down from this day forward, give or take like a couple of months. Bank of Canada did some interesting research recently on like how vulnerable Canadians are to major financial crisis, right? And one of the things that they found was that our home equity does a really good job. It says that basically most households could cover debt payments with liquid assets for at least 1 year. So that's outside of your home equity. But the interesting part is that this number is actually shrinking on a year-over-year basis. So a couple of years ago, it was like 80% of people could pay their lifestyle expenses for 12 or more months, and now it's I mean, it hasn't come off a ton, but it's 70, let's say 75%. You're seeing an increase in people who could pay their or afford their lifestyle expenses for 1 month or less, and this is if they lost their job. and up to 3 months. So now that's over 10% of people could basically only survive 3 months financially if they lost a job. For us in the real estate industry, I mean, we functionally lost, our job, let's say in 2022 when house prices crashed, volume disappeared, and earnings were dropped like 50%. So we obviously we're self-employed, so we didn't lose our job per se, but we did see a huge impact on our employment side. But really more thinking about the broader market, your buyers and sellers of houses. Job losses are going to continue to be one of the bigger factors in the market right now. It's going to be the biggest headwind for buyers who are thinking about buying a house, and it's going to maybe prevent them from doing that. And it's also going to be the biggest headwind or supply creator for people who own houses and lost a job and maybe are in that 3 month or 1 month or even 6 month or 12-month category, and they're getting to the end and they can no longer afford their mortgage. And they're saying, I got to put this house on the market. And so these trends are really important to be paying attention to. They also mentioned that most mortgagors have enough assets to buffer payments, and it talks about all financial assets. So this is kind of where the home equity piece comes into play, and then the liquid piece, which is things that they could sell immediately to cover any shortfall on their household income. And many mortgagers would struggle to buffer their full mortgage payments, especially if relying on liquid assets alone. So the point here is that most people, if they have enough stocks or cash or bonds or whatever stuff they could sell immediately, to pay, for 1 month or 2 months or whatever. But then eventually you burn through all of that stuff, and then you're into your illiquid financial assets. And if your home equity is down, or we're in a credit constricted environment, and I mean, if you're in this position and you're trying to sell stuff to cover your mortgage, you probably, your job situation or credit situation or whatever might be tarnished a little bit. It might not be easy for you to go and get a second mortgage or whatever. Though that's where where these financial stress situations start to materialize in supply. On that note, I will just kind of hop over to the job market, because as I've mentioned for a while, I think this is probably the most important piece. I still think this is more important than the trade war. And I mean, they kind of hold hands, because the trade war, obviously we saw like Stellantis just got rid of 3,000 jobs in Mississauga, or sorry, Brampton. Some Oshawa plants closing, Windsor plants. There's the GM plant in Ingersoll. I think it was 1,000 jobs. So that's all trade war stuff, right? Trump's been trying to get those jobs moved into the U.S., materializing in job losses in the Canadian market. And if you go look at those markets, how they're performing from a real estate perspective, not a lot of buyers. There are a lot of sellers. House prices, there's definitely downward pressure on house prices in those markets. And one of the interesting things, if you go back to the 1990s recession, is that we saw the big drop in house prices, and we saw this in Canada too. I can even actually just fast forward to sort of your house price chart here. So 1990s, house prices came off pretty quickly in like 89, and then they bounced a little bit. And this is sort of what we saw happen in this year, or sorry, in 2023. And then they fell again, and they started to grind down thereafter. But in the 90s, we saw like a little bit of a steeper dip towards the tail end. And a big reason for that was your employment level started falling. So this is your employment rate. It's not just your unemployment, because unemployment can kind of give us a little bit of a bad reading, especially right now where tons of people are leaving Canada, right? We saw 100,000 Canadians, like permanent residents, leave Canada. And we also are seeing record out migration from temporary foreign workers or non-permanent residents. And so if non-permanent residents are leaving and they were part of the labor force, then that actually changes your denominator. And so it could skew your unemployment rate up or down, depends on if they're coming or going. So your total employment rate is the total number of Canadians and the total number of jobs. And in the 90s, your employment rate or your employment level started falling, and with it, house prices continued to fall because there were just not a lot of jobs in the country, and people started getting to their end. And that's what we're seeing happen now. That's kind of the phase that we're at. I don't know how long it goes on. I think a lot of it really does depend on the outcome of this trade war and how good of a deal Canada can get from the USMCA negotiation next year. But that to me is like the biggest piece of the whole real estate puzzle right now. When you're dealing with clients, when you're trying to advise people, when you're trying to figure out if things are going to go in a positive or negative direction, pay very close attention to that, because that is really, I mean, think about the conversations you're having with your buyers. If their confidence is wavering, is it because they have job security issues? Think about the conversations that you're seeing with sellers, where they might be considering selling to try and shore up some cash ahead of potentially losing a job, or they've already lost a job and maybe they're on one income and they can only afford their mortgage for 6 months or whatever it is. These are conversations that we want to get ahead of to help people realize the equity in their homes, so that they don't end up in a bad financial position, because it's important. Like, for example, people know it's going to take you 30 to 60 days to sell your house in most Canadian markets right now. We're not in a 2-week sales cycle like we were in 2021. And so for people who do need to shore up cash, it's really a sooner rather than later kind of decision, rather than waiting till you get to the point where you're in trouble to make that decision.
It's interesting to see the number of people approaching retirement age that are still working.
Yeah. Yeah, I found that interesting as well. And yeah, you're 55 and older. I think the employment level, where are we? Sorry, there we go. I mean, I guess it's low, but it's fallen off of the top, but it's yeah, I mean, historically relatively high. The unemployment rate, I think, though, is for that group is sort of like approaching your kind of COVID. I think people, like, I mean, this to me is like an inflation story, right? If people are choosing to delay retirement, like during COVID, we were hearing about people uh taking their retirements early, right? They're like, screw this. I don't want to try and work from home and learn how to use Zoom and whatever. And I'm just going to retire early. Now we're hearing about people, a couple of years later, we've had all the inflationary impacts and they're in financial trouble, or retirement looks a lot more bleak than they expected because everything costs 22% more than it did before the pandemic. Now people are thinking about, okay, well, maybe I won't make that financial decision yet. I'll wait for a little bit and see what happens, right? And a big piece of this puzzle is, I mean, baby boomers own like 66% of the real estate in Canada right now, or over 60%. And a huge part of this is going to be like, are they going to sell their houses to realize that equity to fund their retirement? Because I mean, the government said it, many different statisticians and economists have said it. Like, most of these people can't afford to retire without tapping their home equity in some way, and the most efficient way to do that is by selling their property and downsizing into a different, a smaller home. I mean, I guess there's switching costs with that, obviously, like you have to pay commission to sell, et cetera. So you're starting to see some people go towards like reverse mortgages or HELOCs, et cetera. But again, you probably need some sort of credit and good underwriting, et cetera. So it's not always an option for a lot of people. On the employment or unemployment rate side of things, it seems to be like kind of a mixed story across the country. Alberta actually posted a lot of big increase in jobs, and a decrease in their unemployment rate. Ontario saw an increase in the unemployment rate. And Ontario really seems to be the ground zero for this, especially with a lot of the manufacturing sector stuff. And you can see on the right-hand side here, you've got your three most unemployed cities in Canada are Windsor, Toronto, and Oshawa. Windsor and Oshawa, obviously, very much exposed to the auto sector. Toronto, I mean, it's kind of an interesting story, and I think it's definitely going to be one to watch. And then you start getting into your Alberta, so Edmonton and Calgary, which is funny because, again, you saw a lot of Toronto people flee for those markets, even though their unemployment rates are pretty high. But by and large, mostly Ontario exposure here on the unemployment side of things, at least on the top end. Okay, I'm gonna jump over to the housing side a little bit here. I already covered the house price, but basically, house prices are continuing to grind down. Um, Sales are I guess it depends on what metric you're looking at nationally. I think they were down from September, but they're sort of like, we're kind of stuck in this long-term channel, but still tucked below the 10-year average, which means that I would say the real estate industry is still like what I would say call in recession, right? I mean, I guess it's growing. We're seeing more transactions. We're seeing prices, depending on the market. Some places they're going down, some places they're creeping up. But we as as realtors won't see like growth in our like GDP or industry unless volume continues to grow. And we are slowly starting to see the number of sales increase. Prices aren't really going to follow. And I actually think if anything, the lower prices go, the more transactions we'll see because affordability is still a huge issue right now. And I'll get to a chart on that. But basically, we're nowhere near where we need to be in what you would call an affordable market. And until house prices become affordable for the marginal buyer to re-enter the market, people just aren't going to re-enter the market. And if they're not re-entering the market, that means that we're not doing deals unless we're doing maybe rentals. Go
Yeah, I
ahead.
had a question here. Somebody is wondering when will we see unemployment impact on housing, on the housing slowdown?
I think you're already seeing it, right? Like if you look at the it's just like it's a slow bleed, right? So I think you see it every day. Every time you see a power of sale, I mean, like some of those are investors, some of them are failed flips, whatever, but a bunch of them are people who lost their jobs that ran out of runway and can't pay the mortgage anymore. There's a lot, and then for every power of sale that you see, there's 10 that you don't see where the person um ran out of money and decided on their own to list their property for sale rather than than failing to pay the mortgage and having the bank list it for them. So there's that. So I think people lose jobs. You see the unemployment rate rise. You see the mortgage arrears rate rise, and gradually more and more supply drips out, and fewer buyers are in the market because they're afraid of losing jobs. So I think I'm of the opinion that we are sort of already seeing the active impact of unemployment in the market. It's the bigger question is like, when does it revert? And that's, to me, is the big question, is how long after unemployment stops rising do we actually start to see kind of a return of optimism in the market. uh any other questions?
No, not right now.
Okay, cool. So on an annualized basis, house prices are still falling. This is a chart from RBC. Um, BMO sort of has the same thing. They track what they would call price momentum, and so your price momentum basically on both a 3, 6, and 12 month is all 0 or below 0. So basically, like, we don't have a lot of velocity for prices to move upward, is what they're trying to say. And right now, it's sort of like, again, 0 or below 0, which means that prices could stay flat or kind of fall slowly, not massively. The interesting part here is that when you measure that against inflation, and inflation being sort of relatively high right now on a real basis, so real house prices adjusted for inflation, people are actually losing money if their house prices aren't growing. Losing, money, let's call it, adjusted for inflation. Market balance is relatively balanced right now. I'm honestly becoming more I'm relying less on the idea of months of inventory and sales to new listings ratio, because I think that, like, the market is behaving so much like a buyer's market in a lot of places in Canada right now. And I won't speak for some of, like, the prairies, or, like, I mean, even Alberta is rolling over a little bit, but some of the stronger markets. But, like, you're at a national level, or like your Toronto's and Vancouver's, they're really behaving like a buyer's market despite having balanced market months of inventory or sales to new listings ratios. And I think a big reason for this is because the flow of information is so much faster in Canada right now, or not in Canada right now. The flow of information is so much faster today, period, than it was in the 90s or 80s when we came up with these metrics for what is a balanced market, or a buyer's market, or a seller's market. And so I'm kind of like trying to interpret how we would shift those metrics around a little bit to see, because right now, like, if you're seeing downward price discovery, more sellers than buyers, and buyers are the ones who have the negotiating power, that's a buyer's market, even though from a data perspective it's in a balanced market. Again, same thing, but just a much nicer chart from RBC that basically shows how we've trended down into a buyer's market. A balanced market. This is an interesting one from BMO that shows basically on a city by city basis which cities are in buyers versus sellers market, and it's actually fewer than last month. Toronto sort of just in buyer's market territory by the technical definition. Barrie, Niagara, and Vancouver are really the only places. The majority of the country is in balanced market territory, and then you've sort of got a couple of outliers. So your affordable markets, Edmonton, Regina, Winnipeg, and then Montreal, Quebec, and the East Coast all seem to be doing well from or in favor of sellers. And the reason is because people can afford to buy houses in those markets. I mention this every month, so I'm not going to belabor it. Um, Oxford Economics did an interesting prediction on house prices and sort of what they expect to happen. So this is from your previous peak, and it shows Toronto. They don't really like looks like Toronto. They basically expect them to stay flat. Canada, slight grind up after basically expect to drop over the next year and a bit, and then trend upwards after that. And so at a national level, their Oxford's expectation is that they expect house prices will probably find a bottom early 26. I think that it'd probably be a little bit later than that. My expectation is probably late 26, and that they expect basically a very slow growth. And people always joke like, oh, why would you? Well, it's obviously not going to be a linear growth line. Well, I mean, it would be as foolish to try and model a bunch of ebbs and flows in that growth line as it would be to make it a straight line. The straight line is typically it's a function of what we know wages typically grow at, and prices are very much a function of wage growth, right? Typically, like your price to income. They modeled out upside and downside scenarios. I really am of the opinion that we're probably more likely to see the downside scenario here. Even the base seems a little bit optimistic to me. Again, price is probably falling not massively, but a little bit more towards the next year. 5-10% down, more downside risk. Again, a lot of it does depend on how bad trade war, recession, and unemployment gets. And on a city by city basis, you've got, basically on the left hand side, all of your growth markets, markets where people can afford to buy houses, they're doing well. On the right hand side, you've got all of your markets that are losing losing value. Home prices are losing value, and they're all places where people cannot afford to buy houses. So affordability really seems to be driving factor here. And this is why I always pull up this housing affordability chart. You can see the double peak again. I've mentioned this a handful of times. What we don't have here is the hallmark of one of these big drops in or improvements in housing affordability is the recession here, which is like the darker bars. But you also, like, if you look back historically, there's like these long flat periods where housing affordability, it stays within this normal channel. We're so far above that right now. Is it possible that Toronto and Vancouver stay unaffordable indefinitely? Yeah, honestly, I mean, they're kind of like that echelon of cities, but like at a Canadian level, and especially on some of like your less like world city kind of places that really target immigration and transitional people moving in to get a job and then go somewhere else in Canada. You can't really run a country where nobody can afford houses. And this is what the government is trying to solve right now. And I actually think they're doing, I mean, the market seems to be doing a good job at making it happen with the assistance of a lot of the government policies, especially like CMHC, MLI Select. And I'll talk a little bit about what's happening on the rental supply side as well. I can just skip over that one. Same thing. I mean, housing affordability, this is basically just your ranking. Again, anything to the left of the national average in Canada here, and even like some of your markets like London. I mean, London seems to be still in a bit of a rough spot, but anything left of the national average, like those markets seem to be doing well, right? People are transacting, save for like Windsor, I would say. Anything to the right, anything in red that's an unaffordable market, they're not doing well, and that's because people can't afford to buy houses. Um, just going to try and wrap up some of these because I'm a little bit short on time and I want to do a little bit of questions. But I mentioned the inflation piece. On inflation, I mean the Oxford basically forecast that we, on a real house price basis, we won't see any growth for like the next decade, right? So basically, house prices are going to grow at the rate of inflation, which means that your house in real terms isn't actually going up. I'll skip this one, but this was basically just showing Toronto compared to other world cities. I'm just going to move this one to next month's call. This is National Bank's housing affordability monitor. It's a really, really good. I would encourage everybody to Google this and just check it out and take a look at your city. But one thing I wanted to observe was the spread that we're seeing in certain markets like Toronto and Vancouver between the cost of renting and buying. And this is really where if renting is more compelling, people will continue to rent, and that actually limits your pool of buyers. And this is a phenomenon that's happening across Canada right now because we're seeing so much rental supply created. Um, and there are other markets like Calgary, as an example, where that spread is much lower, or Ottawa. I mean, Edmonton, I think I had Ottawa in here too somewhere. Yeah, Ottawa, where I mean, the spread is much lower or tight, and you're seeing Ottawa return to a growth market because it costs as much to rent as it does to own a home. And so home ownership actually becomes more compelling relative to renting if you're making a decision purely on a shelter basis. Um, Interesting thought on another one from Oxford. We're now, from my perspective, we're actually now building enough housing. We don't have this undersupply of housing. And a lot of this is because population growth has come down, but a lot of it is also because the number of housing starts that we've been building has gone up substantially to the point where, I mean, in the last 10 years, we have a record number of dwellings under construction. I think you have to go back to like the 70s to see a comparative period of time. And I've made the comparison a lot to the 1990s about how, like, you know, we in the 90s we had similar setups, but there's one thing that I didn't realize, and it shows up in the next chart that I'm going to show you, but that, you know, we don't have this massive oversupply of pre-construction housing sitting on the market. And a lot of that is because a lot of your pre-cons sold through like pre-con realtors. They already had buyers. They weren't unsold inventory. But all that to say, I mean, this is an important phenomenon that might save us from an absolute catastrophe like we saw in the 90s, because we don't have, you know, 250% oversupply of unabsorbed housing units. I think I won't mention Doug Ford's rent control thing. Kind of walk that back. You know what? I think we'll probably just jump to questions because there's nothing else there that I really need to discuss, and I do have a 3 o'clock, so I want to make sure that we get through all that. So yeah, I mean, thank you all for your time. I really appreciate it. And if anybody has any questions, I'm happy to field those now.
Yep, we've got a couple questions. The first one is, what is your thought on investor opportunity?
I mean, I think it varies on a market by market basis. I mean, if I'm just thinking of it from an investor perspective, like, you know, yield, so your rents are going down, like you have to model stuff properly. I think that you know, you have to know what rents are doing in your market, and are you going to stress test if rents fall another 10%, right? Like, let's say, because usually your pro forma, you would use like last year's or a blend of the last couple of years to model out what your deal is going to look like. Do you Would you still do this deal if rents fell another 10%? Would you still do this deal if rents or if vacancy went up to 7%, like it is in like what's happening in Calgary as an example? That to me is like the big question when it comes to investor opportunity. There's a ton of opportunity in the market right now, but people are getting killed by bad underwriting. And so if you underwrite deals properly, you'll do fine. If you don't, then you're probably going to be in a lot of trouble. So that would be my answer to that question.
Do you see any interprovincial movement trends like Alberta attracting people from BC and Ontario?
I think Alberta's probably hit peak growth already, to be honest with you. I would say that yeah, I mean, I think like they were at 11%. I think they dropped to like 4%. Like I don't know if I can see Alberta ever hitting those numbers again, to tell you the truth. So that would be my like, do I think they'll still see some growth? Yeah. Do I think it's going to be 4 or 11%? Probably not. It might be 2 or whatever. Nobody, like, no province is growing right now. And actually, you know, usually when rents are falling in Toronto, and like, no offense to Calgary, because I love Calgary, it's a beautiful city. But like, if you say to somebody, would you rather live in Calgary or Toronto? You know, and especially with return to office and stuff, a lot of people are going to say Toronto, but they couldn't afford to live in Toronto. But now they can, because rents are down 15% in Toronto, and you can get a 1 bedroom in Toronto condo for the same as a 1 bedroom in Calgary. And so that might actually change the migration pattern. We're seeing a bit of a reversion back to sort of the stuff that was happening during the pandemic. And I think a similar thing happening on a suburban basis, right? Like people coming back from the suburban areas into the cores because of return to work and all of those things. So that's probably, and it's easy to observe this in the US as well. If you look at the US right now, um, a lot of stuff is happening where basically, you know, everybody was leaving like California, New York, going to like Florida, Texas, et cetera, and now the opposite is happening, right? So I think you just see a bit of a rebalancing take place. That's my thought.
Okay. And just further to Alberta and the Calgary market, we have in the past the Alberta housing market lagged the Toronto market. What do you see going forward for the Calgary market?
Yeah, it'll be the same thing. I don't think there's any point in which we'll see Alberta exceptionalism. I mean, it's still exposed to Canada's economy. The reason Alberta outperformed and stayed stronger longer was because people could afford houses. Pretty simple, right? Like their wage to income was, or price to income was way better. It still is way better. And so is there more upside there as a result of that? Yeah. But I don't know how much that lag depends on like the wealth effect of Toronto. It did a little bit like when your Toronto pre-con was tapped out and everybody started going to buy investment properties in Calgary, and same thing with people buying, MLI deals in Edmonton right now. So if you see a little bit of equity growth or wealth creation in those markets, but as it stands right now, we've seen a lot of destruction there, in wealth destruction in the province of Ontario at least, and it hasn't been as bad in Alberta, and that's because your marginal buyer can still afford houses in Alberta, and that's kind of keeping the market propped up. So I think it'll break trend because of affordability, but I don't think it'll ever not be somewhat tethered to what's happening everywhere else in the country, unless it becomes Canada's biggest city, which I mean, it could happen in like 30 years, to be honest, in the same way that Toronto sort of like became Canada's city compared to Montreal. But it's like a super long play on that one.
Okay. Is the type of housing being built the type of housing that's meeting the desired demand?
Absolutely not. So like the housing minister came out and said that the that the average prices needed to fall in order to make housing more affordable in Canada, but not individual prices. And there's three ways that you can make this happen. I did a video on this on my YouTube recently, so I would encourage people to go to watch it, but I'll summarize it very quickly. You can build more apartments and fewer detached houses, which we're doing right now, right? So and not everybody wants to live in apartments. Actually, very few people want to live in apartments. Most people want to live in urban areas, and apartments are the only way that they can afford to do that. So you can build more apartments and fewer detached houses. That'll skew your average down. You can build fewer houses in Ontario and more houses in cheaper places like Alberta, Saskatchewan, et cetera, and that'll skew prices down at a national level, right? Your average price will go down because you're building in cheaper markets. And then the final one is you can build more rentals and fewer homes to own. And we're doing that as well. So, the market is assuming that most Canadians and most new household formation are going to want to live in rental apartments. Whereas the truth is, if you ask most Canadians, and there's myriad survey data to this effect, is most Canadians want to live in detached homes that they own. So we're building the exact opposite of what Canadians demand. But the reality is that most Canadians, you don't always get what you want, right? Or whatever the Stone song, you can't always get what you want. And so, unfortunately, people who want to live in a detached house that they own are going to have to make compromises because the economy doesn't always do what you want it to.
Mhm. Okay, and then just last thing, circling back to interest rates, what's your expected rate cut decision tomorrow? And do you foresee the US cutting rates more aggressively?
Yeah. Yeah, I think 25 basis points from the Bank of Canada, 25 basis points from the Fed. Do I think that the U.S. Fed will cut more aggressively? I would say so. They have a dual mandate, and unemployment is rising in the U.S. And like, I mean, you just saw Amazon just cut a bunch of jobs. I think we're just getting to the beginning of layoffs in the U.S. So, I think that they'll cut far more aggressively based on the current data? Probably not. Do I think that there's way more bad data heading for the Federal Reserve? Absolutely. So I think that they will be forced to cut far more aggressively over the next 6 months to a year. Yeah.
Okay, and how can people get these slides after the presentation?
I think if you can share us the email list, I'll email them to everybody if that's cool.
Okay,
Amazing.
all right, well, I think that's everything.
Okay, cool. Thanks so much.
Okay, see you next month.